IRS filing alert. If you're planning to file your taxes the same way you always do, I need you to pause for a second because the IRS quietly rolled out new filing rules and most taxpayers have no idea how big of a problem this is going to be until it's already too late. And no, this isn't one of those minor updates that doesn't really affect anyone. These changes impact how your return is processed, how fast you get your refund, and whether your return gets flagged for review. In other words, this can cost you money, time, or both. Hit subscribe because what I'm about to explain applies to almost everyone who files a tax return in the United States. Let's start with the biggest mistake people are about to make. Most taxpayers think filing early is the smartest move. The logic sounds reasonable. File early, beat the rush, get your refund faster, and move on with your life. That advice used to work. This year, it can backfire in a major way. Here's why. The IRS officially opens tax filing for the 2026 season in late January. Every year, millions of people rush to submit their returns in the first few weeks. Last year alone, tens of millions of taxpayers filed before mid-February, assuming they were getting ahead of the system. But what most people don't understand is that the IRS processes returns in the order they're received, only as long as everything is perfect. The moment there's a missing form, a mismatch, or a number that doesn't line up with what the IRS already has on file, your return gets pulled out of the automatic system. Once that happens, you're no longer in line for a quick refund. You're in the manual review queue, and this year, the manual review queue is about to be flooded. The reason is simple. New rules, new reporting requirements, and incomplete information being sent to taxpayers before everything is finalized. That combination is catching people completely off guard. Here's what changed. For this filing season, the IRS expanded several reporting and verification rules that increase the likelihood your return gets flagged. These aren't dramatic headline changes, but they quietly affect millions of returns. The first issue is income categorization. In prior years, most income was lumped together neatly on your forms. Wages were wages, tips were tips, side income was reported separately. This year, more income categories require additional documentation or specific reporting lines. That means if income is misclassified, even by accident, your return doesn't just get corrected, it gets stopped. Most people assume tax software will catch this. That's a dangerous assumption. Many tax software platforms update in phases. Early filers are often submitting returns before all rule updates, validations, and cross-checks are fully implemented. So the software lets you file, but the IRS system doesn't accept it cleanly. The result? Delays that can stretch for weeks or even months. And here's where it gets worse. The IRS is now doing more automated cross-checking than ever before. Your tax return is no longer evaluated in isolation. It's compared against employer data, payment processor data, and third-party reports in near real time. If something doesn't match, the system doesn't ask questions. It just stops. One of the most common problems this year involves income reported from multiple sources. Gig work, side hustles, online sales, digital payments, and contract income are all being scrutinized more closely than in the past. Many taxpayers don't realize that payment platforms are now reporting transactions at much lower thresholds than in the past. People who casually sold items online, accepted shared expense payments, or did occasional freelance work are suddenly receiving tax forms they've never dealt with before. If those forms aren't included correctly, your return gets flagged. And if you file before all those forms arrive, you're almost guaranteeing a problem. This leads to the next major issue catching people off guard: incomplete documents. A lot of taxpayers file the moment they receive their W-2, assuming that's all they need. But this year, that assumption is risky. Employers, payment platforms, lenders, and brokers are issuing corrected and delayed forms at higher rates than usual. That means a document you receive in late January might not be the final version. If you file using the original version and a corrected form is issued later, the IRS system catches the discrepancy automatically. That's when amended returns, refund freezes, and review notices start showing up. People don't realize that even small corrections can trigger this. A few $100s adjusted, a category reclassified, or a form updated with additional details is enough to trigger it, and once your return is flagged, there's no fast lane to fix it. Here's something else most taxpayers don't factor in. The IRS is handling this filing season with fewer resources than in previous years. That matters more than people think. When a return goes into manual review, it requires a human being to look at it. That means phone calls, letters, follow-up requests, and processing time. If you think, I'll just call the IRS and straighten it out, that's not how it works in practice. Contacting the IRS doesn't automatically speed anything up. In many cases, it actually slows the process because your case gets moved into correspondence handling. That's why filing correctly the first time matters more this year than ever before. Now let's talk about refunds, because this is where people feel the impact the most. Most taxpayers rely on their refunds, whether it's paying bills, catching up on debt, or padding savings. Refund timing matters, and delays hit harder when you're expecting that money. Here's the reality. If your return processes cleanly, refunds are still issued relatively quickly. But if your return is flagged for any reason, timelines change dramatically. Instead of weeks, you're looking at months, and many people won't realize there's a problem until they check their refund status and see vague messages like "still being processed" or "under review." At that point, there's very little you can do except wait. This is exactly why the new rules are catching people off guard. Nothing about the filing process looks obviously different on the surface. The forms look familiar, the software looks familiar, the deadlines haven't changed. But behind the scenes, the tolerance for mistakes is lower. The IRS is relying more on automated systems to catch inconsistencies early. That sounds efficient, but for taxpayers, it means fewer second chances and longer delays when something goes wrong. Before we move on, I want to hear from you. Have you already started gathering your tax documents, or are you planning to file as soon as filing opens? And do you usually file early, or do you wait until later in the season? Drop a comment and let me know, because how you answer that question could make a big difference this year. In the next part, I'm going to break down the specific new rules and reporting changes that are triggering the most delays right now, including the ones that surprise even experienced taxpayers. Now let's get into the actual rule changes that are creating the most problems this filing season, because once you understand these, you'll see why so many returns are getting delayed and why a lot of people don't realize they're affected until the IRS steps in. The first major change involves third-party payment reporting. If you received money through apps like Venmo, PayPal, Cash App, Zelle, or similar platforms, the reporting rules are now much stricter than they were in the past. In previous years, most people never had to think about this unless they were running a business or moving large amounts of money. That's no longer the case. Under the updated rules, payment platforms are required to issue reporting forms when total payments exceed a much lower threshold. That means people who casually sold items online, picked up side gigs, or even received repeated payments for shared expenses may now receive tax forms they've never seen before. Here's where people get tripped up. Many taxpayers assume that if the money wasn't income, they don't need to report it. But the IRS sees it differently at first glance. When a payment platform reports activity, the IRS system expects to see that amount addressed somewhere on your return. If it's not there, the return gets flagged. That doesn't automatically mean you owe tax on that money, but it does mean you have to explain it properly. And if you file before you've received all applicable forms, you're creating a mismatch the system will catch. This is one of the biggest reasons early filers run into trouble. People file as soon as they get their W-2, then later receive a payment platform form they weren't expecting.
At that point, the IRS already has both pieces of information, and your return no longer lines up. The second major issue catching people off guard involves investment and interest reporting. Banks, brokerages, and financial institutions are issuing more detailed reports this year. That includes interest income, dividends, capital gains, and even small amounts that people previously ignored. A few dollars here and there might not sound like a big deal, but automated systems don't ignore small discrepancies. If your return omits income that the IRS already has on record, even if it's minimal, it increases the chance your return gets pulled for review. This is especially common for people with multiple accounts. Savings accounts, money market funds, investment apps, and online banks all report separately. Miss one form and your totals don't match. Another area causing confusion is dependent and credit verification.
Credits tied to dependents, education, and energy-related expenses now require more precise matching. The IRS is cross-checking Social Security numbers, enrollment records, and documentation more aggressively. That means claiming a dependent who was claimed elsewhere, entering an incorrect number, or claiming a credit without finalized documentation can stall your return. Education credits are a good example. Students and parents often file before receiving the final tuition statements or corrected forms from schools. If those forms don't match what's claimed on the return, the IRS flags it. Energy credits are another major trigger. Home energy improvements, electric vehicles, and efficiency upgrades all come with specific eligibility requirements and documentation. Filing before all paperwork is finalized dramatically increases the risk of review. And once again, filing early doesn't reduce that scrutiny. It actually increases the chance you'll have to fix something later. Now let's talk about something most taxpayers don't realize has changed: how errors are handled. In the past, some mistakes were corrected automatically. Math errors, minor discrepancies, or missing information were sometimes fixed by the IRS without stopping your entire return. That's happening less often now. The IRS is shifting toward a verify first, release later approach. Instead of correcting returns and issuing refunds, they're holding refunds until verification is complete. From the taxpayer's perspective, this feels like a delay with no explanation. You check your refund status, it says processing, weeks go by, there's no update. Eventually, you receive a letter asking for documentation or clarification. At that point, the clock resets. You respond, they review, and then you wait again. This is why accuracy matters more than speed this year. Another big change catching people off guard is the increased use of identity and fraud screening. Because of past fraud issues, the IRS is applying more filters to returns that involve refunds, changes in income patterns, or unusual activity compared to prior years. If your income jumped, dropped, or shifted categories significantly, the system may pause your return to make sure it's legitimate. This includes people who changed jobs, went from employee to contractor, retired, or started side income. None of those things are wrong, but they do increase scrutiny. And again, early filing doesn't reduce that scrutiny. It just means you find out sooner that your return needs review. Now here's the part most people really don't expect. The IRS is relying heavily on automation, but automation has limits. When a return falls outside normal parameters, it doesn't get prioritized, it gets set aside. That means the returns with issues don't move at all until someone manually works them. And this filing season, manual processing is slower than usual. That's why the same mistake that caused a short delay a few years ago can now turn into a multi-month wait. This leads to a misconception a lot of taxpayers have. People think that because they filed electronically, used reputable software, and double-checked their numbers, their return is safe. Electronic filing helps, but it doesn't override missing documents, mismatches, or new reporting rules. Software only works with the information you give it. If you don't have all the forms yet, the software can't fix that. Now let me ask you something important. Have you ever received a tax form in February or even March that you forgot about when you filed early in a previous year? A corrected W-2, an interest statement, or a form from an app you barely used? If that's ever happened to you, this year magnifies that risk. In the final part, I'm going to break down exactly what you should do before you file to avoid these problems, including when to wait, what to verify, and how to protect your refund from getting stuck in review. Now that you understand what's changed and why so many returns are getting stuck, let's talk about what actually protects you this filing season. Because avoiding delays isn't about luck, it's about timing, preparation, and knowing what the IRS systems are looking for. These are the steps that matter most this year. First, don't rush to file. That might sound counterintuitive, especially if you're used to filing the moment the IRS opens. But filing too early is one of the biggest risk factors for refund delays right now. Waiting until mid-February gives time for most tax forms to arrive, including corrected documents and reports from payment platforms, banks, and lenders. It also allows tax software to fully update validation rules and error checks tied to the new reporting requirements. Filing early doesn't move you to the front of the line if your return isn't perfect. It just increases the chance you'll be pulled out of automatic processing. Second, make sure you actually have all your documents. That includes more than just your W-2.